Good afternoon, everybody, and welcome to our August webinar on a special date and time. Today, talking about the Trump accounts. Um, Lots of questions out there, lots of ideas about what they are and aren't, and even clouded by political commentary who want to comment on the name of them, Trump accounts, which has nothing to do with what we're going to be covering today. But rather, we'll focus on the financial aspects and the savings element. Today, our presentation is going to be hosted by Justin Rice. But I believe those in attendance have met Justin, but there may be some viewing who have not met Justin yet. Justin is our certified financial planner, or he is a certified financial planner. He also has recently completed his tax planning certification professional designation in the American College. So he is now our resident tax expert as well. Although he may shy away from shy away from that for fear of what questions people might be coming up with. Um, uh, Please join us today as we present on the Trump accounts, and we are going to have the question and answer box open, or the icon open. So click on that if you do have questions, and we'll try and work them into the presentation. And of course, at the end, as we wrap up, we'll field any final questions. So Justin, with that, let me turn it over to you.
Thank you, David. Yep, and I appreciate that. And especially the commentary about even the name of the accounts. And, Trump accounts is not a political name. That is the name that it was given. But I know that, some people don't necessarily jive with the president. And if it makes you feel better, there is a secondary name that you can call the accounts. And so much like you call your employer sponsored plan a 401k at work, 401k is the area in the tax code where it is. And so the Trump accounts actually is under 430A. I mean, 530A. So 530A, if you want to call them 530A accounts, and that makes you feel better, great. But I'm going to call them Trump accounts because that is what they are actually referred to in the law. And we're going to hopefully get you money from these Trump accounts as well, because there are some attractive natures of Trump accounts that we'll review. And there are tax implications of the Trump account. And so the tax planning certified professional designation does help us to navigate some of the tax complexities that come in with the Trump accounts. And so I do want to start off by separating the media headlines from what is actually in the legislation, how the accounts actually work, because, there's definitely a lot of media push on Trump accounts, on what they can do, on, them compounding growth over 50, 60 years and then giving you some huge number that's saying this is what your child could be eligible for. You can turn it into tax-free millions, et cetera. So there's definitely a lot of media press about them. But what we want to do today is really go through, how the accounts work, number one. Number two, how you can qualify potentially for free money, meaning money that you don't actually have to put in. The money is coming from somewhere, and we'll talk about that. And then the third area is, should you contribute additional monies into the accounts for your children? So there's kind of three different sections: what the account actually is, how it works. Number two, how do you qualify for, money that others will put in for you? And then number three, should you actually come out of pocket and put your money in? And so the Trump account is a fancy name, but at the end of the day, what it actually is, it's built upon the traditional IRA. So it's actually a retirement account at its core. And at the child's age 18, that's actually what it transitions into. It transitions into just a traditional IRA. But it's a special child IRA that has restrictions put on it. And so they have this kind of growth period that they designate, which we'll get into, where you can't touch the money at all, virtually no access to funds. It also mandates how those funds are invested. So obviously in an IRA, you can invest that however you want. While it's a Trump account, while the child's below age 18, you only have access to a broad US equity index fund. That's it. And so you have to invest in that, or else you're not going to invest in it. Like I said, it converts to that standard traditional IRA at 18, which does open up some planning options. But another kind of corollary is you've got the Trump accounts that you can save for children, but you also have 529 plans, which are those college savings plans that you could also save for children as well. And we'll talk about the differences in those plans compared with a Trump account and which one you can ultimately decide to invest in. And so here's the transition in the journey of the Trump account. And so I mentioned this growth period, which is actually, established within the legislation. And that's from the period of when the child is born all the way to December 31st of the year of when the child turns 18. I was 17. So January 1st of the year the child turns 18 is when it transitions into that traditional IRA status. So that first phase, that growth period, this is where it's basically locked up. So the parent will control the account. You'll see any money that's in that account. You will see it growing or fluctuating with the U.S. equity investments that it's in. But basically, you can't get any money from that account whatsoever. Then you have that transition. So December 31st at age 17, there are some important deadlines there. So for example, when we talk about the $1,000 seed money later, which is the amount that the Treasury will put into the account for children born between January 1st, 2025 through December 31st, 2028, you can actually claim that money all the way up until December 31st of age 17. So there's reasons to claim it sooner than that, so I wouldn't delay. Um, but in theory, that you could wait all the way until then and still claim that seed money. But also that transition period is also the last opportunity that you would be able to complete a rollover from the Trump account into a qualifying ABLE account, which is kind of past the complexity of what we're going to talk about today. But just know what an ABLE account is really made. It's for those with special needs, for disabilities. And so if that would be relevant for a child that potentially you wouldn't know at birth, but then you would know at age 17, you would have the opportunity. There's some built-in rollover capabilities for that. And then the post-growth phase, once the child reaches 18, it actually becomes their own account. They have access to it. They can manage it how they want to. So in essence, if you build up a lot of money in there over the growth period, the child turns 18, it becomes theirs. They can take it out, pay whatever taxes, pay whatever penalties, go buy a nice car and a Rolex and flaunt with their friends that Trump bought me all this stuff, although that wouldn't be super accurate. But so you want to make sure that's one of the cautionary tales of this is that the child does get complete control at age 18 in that post-growth phase. David, do you have any thoughts about this progression or the journey of a Trump account?
Not so much on the transition, but I think it's important to point out that these Trump accounts are brand new, which we're going to talk about as well. But they are brand new, so some of the questions that people might ask about what's going to happen in the future, uh, we really don't know because we haven't been to the future yet. And some of the questions, as we're going to cover, haven't been answered yet. So we're going to do our best to answer what we can answer, but some things you ask, we might say it's just not yet resolved.
Yep, that's exactly correct. Yep, so there's still interpretations. They're trying to interpret the law, and then the IRS will come out with their thoughts as well about how things work. And we'll continue to update you on those questions as we get answers to them as well. Um, because keep in mind that these accounts were put into law July 4th of 2025, but you couldn't actually open them until July 4th of this year, 2026. So they've been around for a little bit more than a month, and so still very, very new accounts. But let's talk about one of the more exciting aspects of the account, and that's the $1,000 federal pilot contribution. And so the mechanism for this is very, very simple. So if you had a child born between January 1st, 2025 and December 31st, 2028, which just so happens to be the 4 years of Donald Trump's current presidential term, then it's a U.S. citizen with a valid Social Security number. So if they were born here, then clearly that would be the case. And you claim them as a dependent, uh, which should be the case anyway. You would qualify for the $1,000 as soon as the account is opened. How do you do that? You have to file the elected form, which is IRS Form 4547, another nod to the Trump presidential term. You can see that's kind of woven all the way through here, Form 4547. And again, you have to file that before December 31st of the year the child turns 17 to get it, but you shouldn't delay in doing that. The only thing that you get in delaying is lack of growth of that $1,000 because it would not be invested during that entire time. And so if your child qualifies for this $1,000 of seed money, you should open up a Trump account and get the $1,000. Now, that's a separate question of should you contribute your money into it. But if if your child qualifies for the $1,000, there's no reason to delay opening a Trump account. You should do so as soon as reasonably possible after this webinar. It's pretty easy. There's a website that you can go to even file that form. So you don't have to wait until you file your taxes next year. You can file the form with your taxes, or you can do it via the website that they've set up. Now, the caveat here is this $1,000, from a tax perspective, you're not paying any taxes on that money when it goes in. However, the flip side to that is eventually when the child takes the money out, they will have to pay taxes on not only the $1,000, but the growth of that $1,000 on withdrawal. So it's not going to create any tax bill in the current moment. So don't be concerned about that from the $1,000 perspective, but it's a future tax bill, just like your 401ks and IRAs. And if your employer contributes into your 401k for you, you didn't pay any taxes on that. But eventually, when you take it out, you have to pay taxes. It's a similar setup here with this initial $1,000 of seed money. Something else that I will talk about with the additional monies that people put in, and there's been some large press on this. For example, Michael Dell made a $6 billion plus donation into Trump accounts. Now, for those donations, those are actually limited. So it doesn't matter how many children are born between January 1st, 2025 and December 31st, 2028. The $1,000 will be available for all of them. But for those that qualify for the Dell contribution, which I actually don't think I have in this presentation, but it is a child, I believe, under the age of 10, but also not qualifying for the seed money. So meaning you're not going to qualify for the $1,000 plus the Dell contribution. It's either or. So if your child is a little bit older, but under age 10 and a US citizen, valid social security number, all that, they could potentially get $250 deposited in from that Dell contribution. However, there's one additional caveat is your zip code. So if you live in an area where the median household income is above $150,000, you do not qualify for the $250. So there's a website for this that we can post into the chat, or we'll follow up with it afterwards, where you can type in your zip code, the birth year of the child, and then it will tell you if you qualify for the Dell contribution or not. If you do qualify for the Dell contribution, then you should also open up a Trump account as soon as possible, because that Dell contribution is limited to the first 25 million Trump accounts for qualifying children. So once that money runs out, it runs out. There's no more for that. And so you want to claim it if you qualify for that $250. And so those are two areas where it's like, should I open up a Trump account or not? Well, if you qualify for seed money or you qualify for some other type of donation money, then the answer is definitely yes, open up the Trump account as soon as possible. There's also some others. David, do you know the guy from, I think it's Connecticut, that also did something similar to Dell?
I was trying to remember right now as well, and I'm trying to think who it is. But it is something similar. It's a lot less money than Dell put up, but you have to be from Connecticut, so a lot fewer people can qualify.
Yep. Yeah. So yeah, and I imagine more of these will continue to pop up, and so keep track of that. If you qualify for that, other people's money, why not open up the Trump account to claim it? Okay. So talking about the taxes of the Trump account and how it works, because you have the ability, so you have the $1,000 seed, you have different other qualified general philanthropy. So that would be something like what the Dells did, or your employer can offer matching contributions into into your child's Trump account. All of those contributions are not taxed in the moment, but they're taxed later. So they do not create what's called basis within the Trump account. And so eventually, when you take that money out, including the growth, that will be fully taxable as ordinary income. The other side of it is there's a $5,000 annual contribution that the parent can make, friends can make, other family can make, anybody, the neighbor down the street can make into your child's Trump account up to a maximum of $5,000 per year. And those qualify as what's called after-tax contributions. And they actually create basis in the account. And I'm not exactly sure, this is one of the questions outstanding, who is going to be tracking that basis. Our recommendation is that until we know that somebody else is going to be tracking the basis for you, like Robinhood or the custodian is going to be tracking that basis, you should track that basis because that money that you put in is after tax, meaning that when it comes out, you do not pay taxes on that portion of the money on the basis of the money. So the penalty for not tracking basis is that you'll be paying taxes twice. You'll be paying taxes on the money as you earn it and put it into the Trump account, and then your child will be paying taxes as they take the money out of the Trump account. And I don't know about you, but I don't like paying taxes twice. So you want to make sure to track that basis, to have a mechanism for all of the contributions, those after-tax contributions that are going in, to maintain and track that basis. And so how does that work? I'm going to switch to this one, and then I'll go back. Just looking at this basis and how it works in practice. So let's say over the growth period, you make $20,000 of contributions into the Trump account. So that $20,000 is the basis. Then you have the federal seed, that $1,000, that goes in. Then along the way, the employer made some matching contributions into it. So that's an additional $4,000. And then it grew an additional $15,000. So you put in 20, government put in 1,000, employer put in 4,000, and then there's growth on the rest. So now your 20,000 is turned into $40,000. Well, I'm happy I made the math simple on myself because a distribution that would comes out as partial basis, partial taxable. And so in this scenario of $40,000, if you took out $1,000, $500 when you report that would be tax-free. $500 would be reported as taxable because of the 50-50 nature of it. So the more, growth and taxable nature of it that you have, the more taxing the withdrawal will be. So there's always going to be a percentage there. I made it easy in this situation, just being 50-50, but that's the importance of tracking basis, meaning that if you just took that 40,000 out, the entire thing out, $40,000 taxed is a lot more than only $20,000 being taxed. So you need to really track that basis. Okay. Now, another thing to keep in mind is those contributions can only happen during the growth period, which is those first 17 years, up until December 31st of the year the child turns 17. And during that time, when you contribute, there is illiquidity, meaning that you put that money in, it's a lockbox. You cannot get that money out. It is basically inaccessible during that period of time. It has to be maintained in a broad U.S. equity index fund. So the default is the ETF SPYM, that ticker symbol there. So that's the default ETF. They are building out the fund options, so there's going to be other options available, but it's all going to be just broad U.S. equity index funds. And the expenses are capped at 0.1%. So all of these are going to have expense ratios, so the internal costs below 0.1%. And unlike 529 accounts, IRA, traditional IRAs, there's no mechanism for getting the money out during those first 17 years for the growth period. And so you really want to make sure that you or your child don't need this money because you're not going to be able to have access to it once it goes into the Trump account. And so looking at that pivot period, though, as soon as that growth period is over and January 1st of the year the child turns 18, now they are, blessed by the federal government to say, hey, you are now an adult, and the account transitions. So at that point in time, it no longer is considered a Trump account. It is now considered a traditional IRA, and all of the rules of the traditional IRA now apply, meaning contributions the child can make into the account, but they have to have earned income at that point in time. And then there would be limits on how much they can contribute to the IRA. Right now, it would be 7,500, but I imagine in 18 years, the limit's going to be higher than that because it's generally indexed with inflation. The investment restrictions are completely gone, and you do have access, but early withdrawals would face a 10% penalty. You do have the standard exceptions of an IRA, like higher education, first-time home buying, et cetera, that a traditional IRA would have, that would avoid the penalty, but taxes still apply. And so it's not very favorable in that perspective from a tax situation. And so if you do want to use the money in that 18, 19, 20, 21 range, it's going to be highly inefficient in a Trump account. So in theory, you would have access if you qualified for a special, exemption to not face the 10% penalty, but you would still owe taxes. And so in general, how you can think of the Trump account is not for is for your child's retirement. So basically, it's giving them a jumpstart savings for their retirement. It is not for early adulthood or transition or college. That would be handled through other areas. So that is how you would think about a Trump account from that perspective.
Hey,
David,
Justin,
anything else you'd like to add? Yep.
yeah, I just one idea I actually just thought of as I was listening to you present on this idea. When the child turns 18 and they have access there, they could potentially be in a very low tax bracket, maybe a 0% tax bracket. And it may make sense. And again, we haven't seen any of these because no one's lived to age 18 who was born in 2025 or later. But it may make sense to take the withdrawal, pay 0% taxes. Yeah, you got to pay the 10% penalty, but you could then take that money out and then put it into some other type of tool with that being your new basis.
Yep. And in fact, we have a slide on this, David. So I'm glad you
Okay,
talked about
very good.
it.
I knew I saw it somewhere. It
Yep.
wasn't like I was going to come up with that idea.
And in fact, since it turns into a traditional IRA, they would have the option to do a conversion into a Roth IRA. So instead of keeping it in that traditional IRA and having the growth be simply tax deferred and paying a much bigger tax down the line, well, what if you could convert the money at a relatively low bracket? You can avoid the 10% penalty even in that situation, and then you could have it within a Roth IRA. Now, the one thing you want to keep in mind in that particular situation is at age 18, if they're a dependent or if they're a full-time student under age 24, the conversion would count as unearned income. And unearned income for a dependent age 18 or full-time student under 24 in excess of $2,700 in a year is not taxed at the child's tax bracket. It flows up and then is taxed at the parent's tax bracket. And so it may make sense to try to do that, age 18 through 24 if they're a student. And then once they're 24, they may have their own job and may be in a lower tax bracket at that time. So those strategic Roth conversions could still make sense. And then once they're converted into a Roth and you've satisfied the 5-year rule, you could potentially have access to that money without penalty as well at that point in time. So there are definitely potential planning benefits for accumulating money within a Trump account, converting it to a Roth, and then having it grow tax-free into the future. There's a couple of road bumps like the kiddie tax that you need to pay attention to, but that definitely is a great option for those potentially navigating that. The main question that we get is, well, if I want to save money for my child, how can I best do it? And the way I see the Trump account is just another potential option to, in what we have to save for a child. Now, listed on the screen here, we only have those types of accounts where the child is actually involved, meaning they're like listed on the account in some way or fashion. They're a beneficiary on the account, a direct beneficiary, like in the 529 plan perspective. So there's other options that you can utilize, like, for example, just saving in your traditional brokerage account and investing it on behalf of the child and eventually planning to give it to them at some point in the future. So there are other options. So these isn't even the full set of options that you could actually explore, but this is some things, and each have their pluses and minuses. And so, for example, if you're going to be funding for educational use, the 529 is above and beyond going to be the best situation because you've got a completely tax-free growth for educational use, whereas the Trump account is going to be, limited to the exclusion amount for when you reach that age, and there's going to be taxes on the growth of it, not on the basis. So there's some partial tax-free use for education, but not really. The 529 is going to be that way. And let's say the child has earned income. Well, if the child has earned income, why mess around with the Trump account? You can go directly into a custodial Roth IRA, have the money contributed in that account on behalf of the child, and just have the money completely grow tax-free all the way in the future, not have to worry about conversions or basis or anything like that. You just go right into the Roth IRA and set the child up for a tax-free retirement with that Roth IRA. Um, and you have complete investment flexibility when you do that. The custodial brokerage account, the UTMA or UGMA account, that is another potential option as well. And that gives you a little bit more, liquidity even pre-18 if the child, needs money for themselves. You could utilize that UTMA account at pretty much any point in time for expenses for the child. And then the final piece is even cash value life insurance, where the parent is the owner and you have the child being the insured to not only one, make sure to lock in life insurance for them, but accumulate a cash value within that life insurance as well. The final piece that I'll look at is when the child gets control as well. And so for example, the Trump account or the custodial Roth account, it is age 18. And so once they turn 18, that account gets transitioned over to them, and you no longer have a say in it. The UTMA account is similar, but it's the age of majority, so that could be age 18, age 21, depending on your state rules. The 529 plan is interesting because there's no set timeline. So you can maintain the ownership of the 529 account. You can even, if you don't like them anymore, now, if they go to school and let's say they have a sibling and there's extra money in there, you can transition it from one beneficiary to another without any taxation and then use it tax-free for the second child for their higher education. And so you maintain complete control of that 529 for as long as you want. There's no set timeline where it would ever transition to the child. And that's similar way for the cash value life insurance as well. So you're the owner of the contract and you would be able to determine when and if the child ever receives ownership of that policy.
Justin, you mentioned the custodial Roth IRA. I just want to take a moment to clarify for people who don't recognize the terminology here. Custodial Roth IRA just means that you open up a Roth IRA in your child's name. And of course, they're not age 18 yet, so they can't own it. So you are the custodian of that money for them. But the Roth IRA is such a powerful, powerful tool because not only is the contribution once you make it grow tax deferred, but when you take the money out, it's tax free in most circumstances. So it's such a powerful tool that beyond the scope of what we're talking about today with Trump accounts, when your child turns 14 and gets a paper route, is 15, starts babysitting, whatever it might be, as a parent, you might take a look at how much earned income they have. And again, we have to declare taxes on that babysitting income. But but if they have income, you can contribute to their Roth IRA. Let them keep their money to go pay for whatever they're going to be paying for. But you can contribute to the IRA in their name, and you're going to have that money grow tax deferred. And sometimes when we go over these accounts and people hear, well, you can contribute up to $7,500 into a Roth IRA for a child. They say, oh, well, I don't have $7,500. Well, you know what? You can also contribute $100 into a Roth IRA. You don't have to go to the maximum. And these tools are just so powerful that if a child opens up a Roth IRA, and let's say they put in $1,000, it's not unrealistic to say by the time they retire, that might be worth $10,000. And that means that $10,000 is all tax free. So it is a powerful tool. These all are great tools to do certain things. And this chart is really helpful because it helps people to realize, is pre-18 liquidity important to me? Well, if it is, then Trump accounts are out. But if it's not such a big deal for me, well, then maybe that's the Trump account's the answer. If I'm thinking I only want to use this for education, then the 529 plan might be the way to go. If I'm thinking now I want the flexibility that it could be used for the down payment on a house or to start a business, well, then the 529 plan is probably not the way to go. Maybe the Trump account would be I mean, the chart really just helps you pick and choose what's going to be the right choice for you because there is no one solution that fits all circumstances, which is why all these different programs exist.
Yep. No, definitely. And so let's talk about that a little further because we've kind of talked about the general rules of the Trump account, how it works. Um, if you should you open up a Trump account, if you qualify for any type of seed money, the answer is yes. Now let's look at the question of, should you contribute to a Trump account? And where we start here is looking at, your being the parent, your financial plan, your wealth building. And so what we want to make sure that you have first and foremost before you start saving and contributing for your children is that your financial foundation is established, that you have proper emergency funds. You don't have high interest rate credit card debt. So you have your retirement that is, preparing to be fully funded because eventually the child can borrow for their education. You can't borrow for your retirement into the future. And so you need to make sure that your financial house is in order before we start to look at opening and funding accounts for your children. Then once you have your foundation, then we step in and we start to look at the other types of accounts. Well, if the ultimate goal is for educational use and you want to make sure that they have that education so they can earn a good living, then 529 accounts are kind of the easy start of that conversation. But then we could look at, well, maybe if they do have earned income and they've got, you want to get them head started for their retirement, then we can start to look at the custodial Roths or even the Trump accounts. It's just another arrow in the quiver of potential accounts that we can utilize. And so how I would think about it, how I would frame this decision is number one, I would look at does the child have W-2 or self-employment income? And if that's the answer, then I would actually preferentially go towards that custodial Roth IRA because that has some really, really attractive rules, tax-free growth. It's got liquidity. So any basis that you put in there, you have immediate access to take out so that you put in that full 7,500. 2 years later, you could take out that 7,500 with no taxes and no penalty. And so you have some very good flexibility with that account. And so if the child has income, I would earned income, I would preferentially kind of tilt towards that custodial Roth IRA. If they don't have earned income, well, let's look at the next question. Do they have higher education funded, or is that a goal that you want? If they don't have higher education funded and it's a goal for you, then I would prioritize 529 plans because of those tax-free educational withdrawals and and state tax benefits as well, which we didn't talk about. So contributions into a 529, some states have a state tax deduction that you're eligible for making contributions into a 529 plan. So you get tax savings there on the contribution, you get tax deferred growth, and then tax-free use for qualified educational expenses. So that's kind of the next in the hierarchy. But if they've got education fully funded, or you want to be more flexible than just pigeonholing it for education purposes only, then we could look at this next question. Do you need access before the child turns 18? And I would even actually extend that as well to, 19 to 24 or to 55, 59 and a half, because the penalty under the Trump account as it transitions to the traditional IRA, you want to keep that in mind. But if you need that liquidity early, then you might want to look at a taxable brokerage or UTMA account. That has the most flexibility. It's got the least tax friendliness, meaning that you're going to have capital gains, interest taxes, et cetera, as it grows along the way, or when you access it. But you've got complete flexibility in that. And then finally, when you get to, through all of these questions, if you want that forced long-term growth and you don't, want any of these accounts, then that is when you would fund the Trump account. And so that's different. Funding is different than opening. So you can open the Trump account, especially you definitely want to if you qualify for the seed. But this is a question of if you actually want to put your own money into the Trump account. And I would say that, obviously based on this list, it's pretty low on the list in terms of funding things. So what is the strategic next steps for you? Number one, again, claim the seed. So if you're an eligible child born between 25 and 28, you want to claim that $1,000 pilot contribution, get it invested for long-term compound growth. And then any other benefits like the Dell contribution or the specific state contributions, there's going to be more that are going to be eligible for. So keep track of that. And if you qualify, that's when you open it, or you can just open it and be ready to accept contributions from wherever they come and just not fund it yet. That is possible as well. Then if you do actually fund it, you want to make sure that you're tracking the basis in there so you don't expose yourself to future double taxation, you or your child. And then number three is again integrated in. So take a look at that flow chart, look at where should you do 529 accounts, should you do Utmost, should you do something else where you're going to fund that, or should you do the Trump account funding? And it complements that rather than looking to create just an additional account for no reason. And then by the way, your money's locked up. You go to buy a car for your kid when he turns 16, but you're not getting it from the Trump account. That's for sure. So hopefully that gave you a good foundation for the money and the Trump account. And hopefully we can transition to answer some questions here.
Just before we wrap, one last thing I'd like to reiterate, because it's not often that we do a webinar, and as you're wrapping up, you say this is pretty low on the priority list of things to do. But we do want to just want to reiterate that there is $1,000 seed money for those who are eligible. That is free money. You have to fill out a piece of paper to get $1,000, but it pays pretty well on an hourly basis to fill out that piece of paper. So don't get confused when we're talking about the additional funding and all these other options. The seed money is only available in the Trump accounts, and I can't think of a reason why anybody would not want to take, unless you're worried about the government debt and you don't want the government to spend any more money. But other than that, I can't think of any other reason why you would not want to take the government's money.
Yep. Yeah, just to put that in context further as well, because I mean, you do have time to get it. So you're not going to miss out on the $1,000 unless you wait until they're 18 and then it will be $1,000 out. But even if you don't want to wait because of the investment and the compound interest nature of this. So the $1,000 seed money, if you sign up for it today and it grows over that 17 years at a 10% interest rate, that 1,000 will turn into $5,000. And so to the extent that you delay, the longer you delay, the more of that compound growth you're giving up on. And so you want to be, anytime you're investing, it typically makes sense to invest earlier, not later. And so to give it the maximum time for it to be able to grow. And so you're really not costing yourself $1,000 if you don't sign up. You're costing your child $5,000 because you're also delaying the compounding of the growth if you wait till the very last minute. So definitely qualifying for any seed, open up the account. That is an action step. But then to fund it additionally, that takes some more questions. But yes, definitely fans of opening up the Trump account. All right, I do see a
We do have a couple
question.
questions.
Yeah,
Yep.
perfect. Yep, I do see some questions coming
All
in
right.
here.
So the first question that we have is, are there any other investments other than S&P 500 that can go into the Trump account?
So while you're in the growth period, the answer to that is no. So you're only allowed to do US, and it doesn't necessarily have to be S&P 500. It could potentially be, US total market funds, but they're basically going to be very, very similar from an investment perspective. And so it has to be US. It has to be lower than 0.1% in cost. And so those are the options that's going to be available within the Trump account. No other investment option, no international investment option, no small company only investment option, no bond investment option. That's an important consideration too. So even if you did want to potentially use it for 18, 19, age 18, 19, 20, and you could qualify for some exemption where you wouldn't have to pay the 10% penalty. What if the market corrects at age 17, right before you're able to change the investments when the child turns 18, and you lose, we go through a 2008 and you lose 40% of the account. I mean, that you can't prevent it. You have to stay invested through that whole 17-year period. And so therefore, long story short, this is long-term money.
Then we have a question from apparently one of our fans who wants to know, can you work with an advisor with your Trump account?
So during that growth period, no. You have to open it directly through the app, the website, and it's managed directly through. Now, can we help advise you on your Trump account? Yes, because that's what we're doing here. We're talking about the Trump account. We're, coordinating it with your overall financial plan. We can let you know, does it make sense in your particular situation to contribute to a Trump account for the child or not? So although we won't be able to manage it directly, um, we can definitely help in that decision-making process during the growth phase. Then once it goes into the traditional IRA at age 18, then yes, it just is treated as a traditional IRA. The investment flexibility is now there. You can just, manage it however you want, and we can, at that point in time, help to manage the account directly.
Yeah, I would have to imagine that pretty much any financial advisor, whether it be our firm or another firm, would be more than willing to provide guidance on these. If you have a financial advisor who you're actively working with, if you're invested through an 800 number, we'll just describe it as you're doing it on your own. If you call an 800 number, they are much less likely to give you advice outside of their the investment that they're actually managing for you. So that is a plug for independent financial advisors, but but I think anybody would be willing to help you out, particularly while these things are getting started and the balances are relatively low.
Yep.
All right.
Um,
Let's see. Oop, got another question coming in late here. This is only available to U.S. citizens, correct? If two non-citizen parents, would someone else have to be the custodian? So the question, I think, if I can paraphrase it, is the U.S. citizen requirement on the child or on the parent or the
yep.
guardian?
So I'm fairly confident it is just the child. So if the child is a U.S. citizen, the parent, even if they're non-citizen, can open up the account for the Trump account. And in fact, this is an important scenario to bring up, that there actually is a hierarchy of who can open up the Trump account for the child. And actually, the first in the hierarchy is not the parents, it's the guardian. So if there is a guardian, they can open up the child the Trump account, the parents could not. Now, if there's no guardian, or obviously if the parents are the guardian, which is typical in most situations, then it would be the parents. After the parents, then I believe the next in the hierarchy is the grandparents. So grandparents can open up Trump accounts for children, but only if there's no parents and guardian. So, for my kids, my parents could not open up Trump accounts for them. Since I'm available to, I would have to be the one to do that because there's a hierarchy there. Um,
Yeah, and that's a great point too, because I know a lot of the people who've joined us today are joining us as grandparents, and they're looking out for their grandkids. So this is good information to share with your kids, your grandchild's parents, and to tell them they should be doing this now. Take action on this now.
Yep. And that's unlike the 529 plan, for an example. So the grandparent could be an owner with the child as a beneficiary and contribute, and not have to have the parents involved at all. Um, where that is not the case with Trump accounts. There is a hierarchy of who can open it and establish it for the child.
So another criteria to put on your matrix there is, are you the grandparent and want control?
Yep.
Um, Yeah, and it really just points out to the complexity of investing. There are so many different types of accounts out there. There are so many different types of investments out there. There are so many different products out there. Why do they all exist? Generally they all exist because they all do something particularly well, but none of them do everything well. So you have to be able to sort through this criteria and say, if that's one of the things I'm interested in, I'm a grandparent and I want to have some control over this money. I want to make sure my grandkid comes and visits me in the future. Then you will not do anything more than the seed money in a Trump account because you won't have that kind of control. On the other hand, maybe you just want to get these things going and you want to see the money go into an account and you've gone through the matrix and none of the other things make sense, then this does make sense. This might be something that would make sense for you.
Yep. Yep. I do see one final question in here. Does this count as a gift? How is it considered? Um, that is a great question. So, yes, it is considered a gift. And it's interesting, there was just some feedback posted on this because when you're gifting, typically there's the $19,000 exclusion before you have to file a gift tax return. And so you can gift somebody up to $19,000 of present value in any given year and not have to file a return. Well, a Trump account contribution because there's that lockup period. So the child doesn't have immediate access. So in theory, it's not a present value gift, it is a future value gift. And if it's a future value gift, it does not qualify for the exclusion. It would count towards your gift tax from $1. However, they have a special exemption for contributions into the Trump account, where if you do not have to file a gift tax return, that Form 709, then you don't have to report the Trump account as against your gift. So they kind of say, you can count it as a present value gift if you don't otherwise have to file that Form 709. But if you do have to file that Form 709 because of other gifts that you have made, or you're doing gift splitting with your spouse, and you have to file that form, then you do have to include that up to $5,000 of that contribution to the Trump account as a future value gift that would go against your exclusion. So there's definitely some complication there as well. So if you don't have to file a gift return, you don't have to worry about it. If you do have to file a gift return, you do have to worry about it.
So to translate that for if anyone didn't follow that complication is if you're thinking about giving a gift of that size, check with your financial advisor.
Yes, financial advisor, tax accountant, check with somebody because
Yeah.
yeah, it does get complicated. All
All
right.
right, that completes all the questions that we have. Justin, I thank you for your presentation today. It was very informative. I know I learned some stuff and I'm in the business. So this has been really good. If anybody on the either seeing us live or seeing this after the fact on our YouTube channel does have follow-up questions, please feel free to reach out to our office. We'd be happy to give some guidance. You know, one of the things that we do get um, a fair number of questions on are government-run programs, whether it be Social Security, Medicare, because sometimes there's just not a lot of places to go to get a good advice or counsel on those types of programs. Um, I thank you all for joining us today. Please keep an eye out for our September webinar, which will return to our normal first Wednesday of the month, which in September is September 2nd. And we'll be announcing the topic real soon. And we hope to see you there.